Gold prices have hit an all-time high. This shiny metal is catching everyone's eye. But it's not just regular folks who are buying gold. Big players are getting in on the action too. Central banks around the world are buying lots of gold. They're stocking up like never before. Why are central banks so interested in gold? It's not just about having something pretty to look at. Gold has always been seen as valuable. It's been used as money for thousands of years. Even now, when we use paper money and credit cards, gold is still important. Central banks see it as a safe bet. When times get tough, gold often keeps its value. Countries like China, Russia, and India are leading the way. They're buying tons of gold. This gold buying spree is having a big effect on gold prices. Gold has been special for a very long time. People have valued it for thousands of years. In ancient times, gold was used to make beautiful things. Kings and queens wore gold crowns. People traded with gold coins. It was seen as something precious and rare. This view of gold hasn't really changed over time. Even when paper money became common, gold stayed important. For a long time, paper money was backed by gold. This was called the gold standard. Historian central banks have a long history with gold. They've been keeping gold in their vaults for a very long time. Even after the gold standard ended, they kept holding on to gold. It's like a tradition that never went away. In recent years, something interesting has been happening. Central banks are buying more gold than ever before. This isn't just a small increase, it's a big change. Many central banks are adding tons of gold to their reserves. Financial analyst countries that didn't buy much gold before are now buying a lot. Russia and China are two big examples. They've been buying gold in large amounts. Other countries are joining in too. Turkey, India, and many others are increasing their gold reserves. This trend is different from what we've seen in the past. For many years, central banks were selling gold, but now that's completely changed. Central banks are using gold to make their reserves stronger. They don't want to rely too much on other countries' money. Gold gives them more independence. Economist. Another reason for buying gold is low interest rates. When interest rates are low, keeping money in banks doesn't earn much. Gold becomes more attractive in these times. It doesn't pay interest, but it can go up in value. Central banks are looking at this and deciding gold is a good option. Inflation is a big worry for many central banks.
Inflation means prices go up and money becomes worth less. When there's a lot of inflation, people's savings lose value. Central banks are worried this might happen. They're buying gold as a way to protect against inflation.
Gold often goes up in price when inflation is high. Many countries are also worried about the US dollar. For a long time, the dollar has been the world's most important currency. But some countries think this might change. They don't want to rely too much on dollars.
Gold is a way to have wealth that isn't tied to any one country's money. It's like having a backup plan.
The world is going through some tense times. There are arguments between big countries. Trade wars, political fights, and other problems are making people nervous. When the world feels unsure, gold becomes more popular. Central banks are buying gold to feel safer in this uncertain world.
One big issue is the trade fight between the US and China. These are the world's two biggest economies. When they argue, it affects everyone. This fight has made many countries worry about the future. They're buying gold as a way to protect themselves. Gold is seen as something that will keep its value, even if trade gets worse.
There are also worries about changes in world power. For a long time, the US has been the most powerful country. Gold has always been seen as a safe place to put money when times are tough. This idea is called a safe haven. When other investments seem risky, people turn to gold.
Central banks are doing the same thing. They're using gold as a way to feel more secure when the world seems uncertain.
There have been many economic crises in recent years. The big crash in 2008 scared a lot of people. It made many central banks rethink how they manage money. They started to see gold as more important. Gold didn't lose value like many other investments did during that crisis. This made it look very attractive.
Natural disasters and health crises also make gold more valuable. We've seen this with things like the COVID-19 pandemic. When big, unexpected events happen, gold often goes up in price.
Central banks have a big effect on gold prices. Their actions and policies can significantly influence the market. When they buy a lot of gold, it usually makes the price go up. This is because their large-scale purchases increase demand. This is because there's only so much gold in the world. The supply of gold is relatively fixed, and mining new gold is a slow process. When big buyers like central banks want more, it makes gold more scarce. This scarcity can drive up prices as there is less gold available for other buyers. Scarcity often leads to higher prices. As the availability of gold decreases, those who want to buy it are willing to pay more.
The policies of central banks also affect gold in other ways. Their decisions on interest rates and economic policies can have a big impact. When they keep interest rates low, it often helps gold prices. Low interest rates reduce the opportunity cost of holding gold. Low interest rates mean people earn less on savings in the bank. This makes alternative investments like gold more appealing. This makes gold look more attractive. Investors seek out gold as a store of value when returns on savings accounts are low. People and banks might buy gold instead of keeping money in accounts that don't earn much. This shift in investment can drive up gold prices.
Central banks also influence gold prices through their statements. Their comments on the economy can sway investor sentiment. When they say they're worried about the economy, people often buy more gold. Gold is seen as a safe haven in times of economic uncertainty. This can push prices up. Investors flock to gold to protect their wealth, driving up demand and prices. Even if central banks don't buy gold themselves, just talking about economic problems can make gold more valuable. Their influence on market perceptions is powerful.
Sometimes central banks sell gold too. This can have the opposite effect, increasing supply and potentially lowering prices.
Many central banks are trying to diversify their reserves to mitigate risks and ensure financial stability. This means they don't want to rely too much on one thing, especially the US dollar, which has been dominant for decades. For a long time, they've held mostly US dollars as their primary reserve currency. Now they're changing this approach. They're buying gold as a way to have different kinds of assets in their portfolios, which can provide a hedge against economic uncertainties. This helps spread out their risk and reduces the potential impact of any single asset's volatility on their overall reserves.
The US dollar has been the world's most important currency for a long time, serving as the primary reserve currency for many nations. But some countries are worried about this heavy reliance on the US dollar, especially given recent economic fluctuations and geopolitical tensions. They think it gives the US too much power and influence over the global economy, which can be risky for other nations. By buying gold, they're trying to be less dependent on the dollar and more resilient to economic shocks. It's like not putting all their eggs in one basket, ensuring that their financial stability isn't tied to the fate of a single currency.
Gold is seen as a good way to diversify because it's not tied to any one country and has historically been a stable store of value. It has value all over the world, making it a universally accepted asset that can be traded and held with confidence. This makes it different from currencies, which can be affected by what happens in their home countries, including political instability and economic policies. As central banks continue to seek stability and reduce risks, the trend of diversifying with gold is likely to grow, shaping the future of global financial strategies. The future of gold in global finance looks bright. As we move forward, gold continues to be a cornerstone of economic stability and a hedge against inflation. Its historical significance and enduring value make it a reliable asset in uncertain times. Many experts think central banks will keep buying gold. This trend is driven by the desire to diversify reserves and reduce reliance on fiat currencies, which can be more volatile. They see it as a long-term trend, not just a short-term thing. Central banks are looking at gold as a strategic asset that can provide security and stability over decades, not just years. This could mean gold prices stay high or even go up more in the coming years. The demand from central banks, coupled with limited supply, could create a scenario where gold becomes even more valuable.
There's talk about gold playing a bigger role in the world's money system. As global economies face new challenges, gold's stability makes it an attractive option for bolstering financial systems. Some people think we might see new ways of using gold in international trade. This could include gold-backed trade agreements or using gold as collateral in international loans. There are ideas about digital currencies backed by gold. These digital currencies could combine the stability of gold with the convenience of modern technology, offering a new way to conduct transactions. While these are just ideas now, they show that people are thinking about gold in new ways. Innovations in financial technology could lead to a resurgence in gold's prominence in the global economy.
Climate change might also affect gold's future. As environmental concerns grow, the impact of gold mining on ecosystems and communities is becoming a significant issue. Mining gold can be bad for the environment. The process often involves harmful chemicals and can lead to deforestation and water pollution. This might make gold even more valuable if it becomes harder to mine. As regulations tighten and mining becomes more challenging, the scarcity of gold could drive its value higher. Central banks are probably thinking about this too. They are likely considering the long-term implications of environmental policies on gold supply. They might buy more gold now, thinking it could be harder to get in the future. By securing gold reserves today, central banks can ensure they have a stable asset to rely on in times of economic uncertainty.
In the end, gold's role in global finance is likely to stay important. Its unique properties and historical significance ensure that it will remain a key player in the financial world, adapting to new challenges and opportunities as they arise.